welcome to BloombergQuint. Now, governments and central banks around the world have stepped up emergency responses to help their individual economies and the global economy cope with the COVID fight. Here in India, we've had some fiscal response, 2 rounds of monetary/regulatory response. Is it working? What more needs to be done to first tide us through this period of uncertainty and then take us back to where we were before it started? Joining us to talk about some of that is Hitendra of HSBC, one of the longest watchers of the Indian economy and the Indian financial markets. Mr. Dave, thank you so much for joining us on this call. Appreciate your time. I'm going to start, Mr. Dave, by asking you for your big picture as you watched what has played out over the last month or so, both globally and domestically. I think the perception here in India is that we've had a relatively weak fiscal response, considerable monetary and regulatory response, although there's uncertainty on how much it's helping at this stage. But what's your view, sir?
Yeah, hi, morning, Ira, and thank you for having me over. I think for people who are comparing India's fiscal response with the global fiscal response, the unfortunate fact is that our starting point is very different from the starting point of many other fiscs around the world. You know, our starting point is a combined fiscal deficit of anywhere between 8 to 9%, while a lot of other countries were in the very low single digits. So we can't run away from this reality. You cannot also run away from the reality that unlike sovereigns where the bonds issued are globally in demand, our bonds have to be issued and invested in largely by the local population. So I think my sense is that the response globally obviously is going to make sure that whatever it is that the fiscs could do and the central banks could do, I can't imagine anyone asking for a bigger package than what's happened in US, UK, EU, Japan, etc., etc. And to that extent, I think given that these are large developed economies, large sources of demand, large sources of industrial and consumer demand, one therefore expects that as and when some of the uncertainty around COVID reduces, you should therefore see a bounce back sooner than what would have happened in the absence of this. I think coming to India, I actually think we have one of the best mechanisms to get money into the bottom of the pyramid, and I think we shouldn't underappreciate that. Just imagine if this thing had happened 10 years back or so, and we couldn't get money through to 50 crore, 60 crore people in the country. I just read today morning that some 37,000 crores has already been distributed. Now that's a reasonable amount of money to get distributed to 10 odd crore households. That means 50, 60 crore people. I'm assuming something similar will get done again in April and maybe even in May. I think if we can keep the bottom of the pyramid from simply becoming very, very dry, and I think the DBT channel, the Jandan channel, the Manrega channel, the fact that money goes directly now from center and states to the accounts of the beneficiary, it is going to help us really avoid a complete demand and an economic shock. In the absence of this, you would have had almost 50% of India's population be deprived of income, be deprived of any cash flow, and which would have both significant societal and economic challenges. So from the point of view of the fiscal response, while it appears to be underwhelming relative to other countries, I think it is very well directed in that sense. And I just hope that they do more of it, because you want to keep bottom of the pyramid extremely lubricated. I mean, in my view, this is essentially, if you remove the social and the other element of it, this is essentially a cash flow problem, right? So the biggest entity in the country, the government, is really suffering cash flows because they're not really realizing any GST revenues, any revenues due from excise on fuel and so on and so forth, because there is no economic activity happening. And then you have companies which are experiencing the same thing because, if you're a business and you're not selling anything, you don't generate any cash flow. The only segment of the economy which is not experiencing this is, the formally employed people such as you and me, who continue to receive salary. And in fact, we are spending less of that cash, and therefore the more we have, the less is what the businesses have. So I think if we can keep bottom of the pyramid lubricated, which is what I think the fisc is doing, if we can keep the top of the pyramid lubricated through the TLTRO or general access to bank finance, which remains strong for the top 100 companies. I think when top 100 companies have access to finance, it's not just 100 companies. There are then thousands of employees below that. I'm sure they'll take care of some of their largest vendors and stakeholders and supply chains. It's the one between these two, the bottom of the pyramid and the top of the pyramid, where I think we need to solve for, and for which in India, at least, we don't really have easy solutions. And that's where I guess everyone's thought process has to be.
That's on the fiscal side. Let me, specifically come to the monetary side. Mr. Dave. We had the first response, which was very steep rate cuts, flooding the system with liquidity. But between that first package and the second package, the view is that, well, at least the liquidity is just sitting with the central bank. So what did you make of the initial response, which seemed to be directed at keeping markets liquid and keeping markets orderly?
Yeah. No, I think if you take back to 27th of March when they did the formal MPC decision, I don't think anyone was expecting what they came out with, right? I mean, nobody was expecting them to go from 5.15 to 4.40 and to go from the reverse repo take even more additional 15 basis points to 4%. I think plus the TLTROs and things of that nature, which apart from providing liquidity, also ensure that it's directed, and which is the top of the pyramid, like which I'm talking about. And it's very important to have large companies well funded because they affect a very large ecosystem. So, and I think if you read anyone's comments on thereafter, it looked like RBI has done everything that it could. I mean, it almost looked like, okay, they have done their bit, now over to the fiscal. I mean, that's how it was, or over to the banks, or over to the corporates to do their bit, etc. What the central bank can do, right? I mean, reduce the cost of money, make the availability of liquidity very, very evident, and keep saying that I will do more and more. I think there were the regulatory elements of relief and things of that nature. I think it's fairly evident that the central bank is not almost, it's 100% committed to doing their bit, right? I mean, and therefore, last week on unscheduled basis, just this Friday, once again, on top of the measures which everyone said is like fully comprehensive, way beyond what anyone thought, come out and then further lower the reverse repo rate, announce a TLTRO to tweak the relief mechanism, yet at the same time ensure that everybody in the system knows the banks are fully provided or fully provisioned for. So they're giving the relief on the SMA1, SMA2 accounts which were on 1st of March, but also are saying if you give relief to those people, then you have to provide some additional upfront provisioning, which I think is prudently the right thing to do. You can have a situation where everybody in the market is going to be additional provisioning, but from an accounting perspective, we don't provide it. Whether banks provide it or not, the investor community or the creditor community globally would have seen that it needed provisioning. So I think from an RBI perspective, I think the challenge is that they can provide the liquidity and they can do all the TLTROs. Unfortunately, no amount of liquidity creates credit risk appetite. I mean, that we've seen for the last 12, 13 years, or especially in our case also last 2 years or so, where you can give funding at zero cost almost, but nobody will take a credit risk if they're not comfortable. And that's again one of the things we have to solve for. Other countries have managed to solve for this issue. And this takes me back to the original point. I mean, if our starting point was a much lower level of fisc, I am sure the fisc could easily take on additional contingent liabilities or come out with a structure or a mechanism so that banks would be incentivized or credit incentivized, I would say, to lend to the middle of the pack. But from what I hear, I think they are thinking of addressing this in a manner that does not expose them to endless and open-ended risk, and it doesn't come out like a waiver. And I think, frankly, they are seeking suggestions on how to make it work. So that's, I think it's not off their radar is what I'm saying.
Okay, so this is the liquidity point. I mean, it's all going into the reverse repo window, 3.5-4 lakh crores on days. Now, the point is that it should have at least gone into bonds, the relatively risk-free bonds, whether it's government, central government bonds or state government bonds. But we've seen the curve remain very, very steep. So what is the problem? The liquidity is not even going into relatively risk-free assets, or is it going into the absolute short term? So you have perhaps, T-bill rates, etc., doing okay, but anything with a little bit of duration is not.
Yeah, again, I think two things here, Ira. I think one is what you are experiencing in India is what you have seen globally. If I think all of us watch US Treasury markets and all that. US T-bills are at zero or negative. Okay, it's exactly the same phenomena. And that phenomena reflects that very few people in the system right now have any risk appetite. We normally focus on credit risk appetite, but there is very little focus also on mark-to-market risk appetite as well. I think if you talk to anybody in the banking system who's been around, and you were charitable enough to say that I've been observing it for a long time, which essentially is a comment on how long you've been in the system. But the biggest mark-to-market losses happen when bonds are at extreme lows, and that those memories haven't faded, right? I mean, just if you look at the results of many banks for March 17, March 18, they were struggling with credit losses, and then they had mark-to-market losses, right? So you can understand why there is a reluctance, and this is a global phenomenon. I think coming to India, I think there is also the fact that everybody's saying, oh, the fisc is underwhelming, it's not doing enough. You read some of the reports, it says do 10% of GDP. You're already at 8, so you'll be at 18% of GDP. Who's going to fund this 10% of GDP? 10% of GDP means $300 billion, right? So that's 21 lakh crore if I've got my numbers right or something. I mean, we struggle to sell 7-8 lakh crore. What are we talking about here? So therefore, if God knows whether it will be 10% or 1% or 2% or 5%, we know broadly it will be in between these two, in between 1 and 10% somewhere. But so therefore, if you are then a bond market participant, in the absence of that information, you are obviously going to say it's very attractive. The reverse repo rate is the operative rate. I can refinance myself in the third-party private repo markets at less than 3% actually. So it's very compelling, but I'd rather not take the mark-to-market risk till I get clarity. So my sense is at some stage, once we know the true economic cost and the true economic damage done and what are the various stimuluses and incentives that the government wants to provide, whatever that number be, whether it's 2 lakh crore or 5 lakh crore or whatever, I think once they say this is the size of the one-off package that we are introducing, and this is how we will retire these obligations. Okay, because the two will have to go together. You can't just announce a package and say, no, it's part of the general budget. So you have to say these special liabilities that we have taken directed at A, B, C, D, E activities, whether it's guaranteeing SME loans, whether it's additional transfers of 40,000 crores per month to 10 crore household for 2 more months, whether it's capitalizing certain entities so that they can provide credit guarantees, or giving GST relief to the most affected sectors on the recovery path, let's say airlines and hotels and restaurants and places like that, where we know that the damage has been the most. And then say this is how we will retire these liabilities. We are going to, and I think on that, at least I would think the best way to retire, to make sure that the package seems credible and comprehensive, is to use India's population as your strength. I mean, there are 130 crores of us. That means there are 130 crore mobile phone bills every month. There are presumably 6 to 7 crore electricity bills every month, or maybe 10 crore electricity bills every month. We do millions of UPI transactions every day. We do millions of ordering from e-commerce websites. I think we'll have to, we buy petrol, diesel. I think just identify 10, 20 activities that are used by 10 crore people every month, and keep charging, somewhere 50 paisa, somewhere 1 rupee, somewhere 5 rupees, somewhere 20 rupees. If your mobile phone bill is 1,000, just say this is a 50 rupee cess. That's how it will have to be shown that, okay, this additional debt of 5 lakh crore, just for example, we have taken, will be retired over the next 7 years by earmarking special cesses from these 10, 12 activities. The reality is the rating agencies look at fiscal loosening by emerging markets in a very different light to what they look at in the developed world, and we can't run away from that reality. So I hope it's a balanced fiscal package, but it's comprehensive. It shows how we will meet the obligations also, as opposed to not just which sectors we focus on.
So you're saying that these additional liabilities will have to be funded through taxes, not through what everyone is now saying, which is some sort of central bank monetization. I don't know if for this quantity simply OMOs are going to be enough, or there are people who are saying, well, this is an extraordinary situation, go back to 1997, do some private placement for a short period of time if required with the central bank.
No, I think you will have to be open to all ideas. I don't think you can say 100% of the additional borrowing you can just ask the central bank to take up. I am not sure that's because eventually then it will invite scrutiny of a whole bunch of people. I think if you can find a good mix where some of it is central bank, as long as it is justified and is proportional, and a significant part of it is through retirement of obligations through earmarked sources of revenues, and some of it is through presumably higher tax to GDP buoyancy. Is one assumes that there will be buoyancy in the next financial year for sure, because there will be suppressed demand, etc. So I think it will have to be a mix of everything, but I'm not sure 100% package funded by the central bank fully. I think it will cause potentially problems, and And at this juncture, I also think that none of us know the true cost. I mean, that's the other problem, right? I mean, none of us are experienced in this space. I mean, when was the last time we thought we won't step out of our house for 30 days or 40 days at a stretch, that we will never have a cup of coffee outside our house or whatever? So the economic damage done to the vada pav seller, to the pan shop owner, or to the restaurant, to the airline, or to the everything is unknown. So my guess is, I think I'm a little bit sympathetic to the fisc for being, trying to comprehend the scale of the problem and then come out with a solution. In the interim, I would come back to one thing, that this is a cash flow problem. In the meanwhile, please make sure that everybody who's suffering from absence of cash flows, their money, somehow or the other, get the money to them. So through banks at the top end, through DBT at the bottom end, and to the middle end through the credit guarantee. Because this, if we have cash flow in the pockets of people, I think we give ourselves a much better chance of a smoother and a sharper recovery. And I would therefore say that this is a cash flow problem.
Okay. No, sorry to have interrupted you. I was just coming to a slightly longer term, and I want to get your experience. You deal with a lot of corporates as well. What are you picking up from them? Are they hunkering down for, say, 3 months because they think after that demand will rebound? Are they fully prepared for maybe a year more of weak demand? Because honestly, nobody really knows, right? So at this point, your first instinct will be, let's conserve, rather than spend on anything or invest on anything. Is that the mood you're picking up, or is it different?
No, I am sure. See, I am sure almost every large company globally. Okay, this again. See, I just want to make sure that everything that we're experiencing here, including a steeper yield curve or whatever, this is a global phenomenon. So if you see in US, what's happened, right? Companies have just gone on a borrowing binge. Okay, they have borrowed $300 billion in the last 4 weeks, which is an incredible amount of borrowing, right? Very, very large. I'm talking about investment grade, and if I add non-investment grade, it will be another $100 billion, etc. And obviously, all of this is not for capex or for meeting immediate expenditure needs or for anything. This is all to hunker down on liquidity. You go back to your board and say, I can survive this crisis for the next 1 year. I have money now to meet my minimum fixed costs, wages, I can retain employees, I can take care of my key stakeholders in the ecosystem, supply chain, vendors, etc., etc. And therefore, and that's the same thing we are seeing here. A lot of large companies don't need the liquidity, but they look out of the window and they don't know where this tunnel is, how long this tunnel is, when it's going to end, when the consumer will come back. Who is to know? I mean, who is to know after 50 days of not having eaten out whether our permanent eating habits will change or not? I see this is because it's 130 crores of us. How we will react at the end of this, we don't know. Whether some of us might be brave enough to say, let's go out, and some of us might say, listen, you know what, I don't want to go out and risk myself or the society for an additional period of 2-3 months or something. So because of that uncertainty, the natural response of any corporate, a responsible corporate, would be to say, let me keep liquidity in my pocket, because I want to come out as a survivor. I think business, P&L, market share, etc., we will see once there is resumption of normal activities. But in the meanwhile, I don't want to be one of those people who just gets too caught up in the illiquidity trap. So yes, to your question, what we are definitely seeing, especially amongst the larger corporates, and this TLTRO1 tells you that, right? The number of companies that have issued debt, I think most of them is for general corporate purpose. Most of it is just take the money and put it into liquid funds or into bank deposits. It's not for meeting expenditure needs or capex needs. The risk is a lot of companies, of course, reduce their capex plans, which then has longer term implications, right? I mean, and that's where authorities have to somehow or the other keep focusing that if and when things start normalizing, anyone knows in let's say in the quarter of July, whenever things start becoming a bit more normal, you have to drive consumer traffic back into segments which need it the most. So if whether it's through GST reduction, the accelerated expenditure allowances or whatever, you need the consumer, especially I would say once again, people who are in the formal salaried class who actually are experiencing the cash flow problem of the business is the positive cash flow of the salary.
Yeah.
We receive the salary and we're spending much less than what we need or what we used to. So we have to get that money out into those through incentives and motivation so that the reluctance overcomes. Okay, if you fly for the next 6 months, it's much cheaper than it would be. If you go to stay at a hotel, it'll be much cheaper. If you buy gifts for your spouse or whatever. I think things of that nature will have to be thought through for the recovery part.
Okay. Mr. Dave, a couple of last questions. So one again is slightly large corporates. So firstly, is the pool of corporates who can borrow money both domestically, because I assume the overseas markets are more or less closed right now, reducing? And secondly, what happens to the Indian corporates who went and borrowed very heavily in the ECB market? I think last year was a record year for ECBs. We haven't seen a run on the rupee, but there is weakness on the rupee, and perhaps some of those liabilities would have to get refinanced locally. What is that global borrowing / local borrowing intersection looking like?
No, I think that's the genesis of the TLTRO, right? That you realize that the conventional sources of borrowings for the large and highly rated companies were drying up. Because the largest investors that tended to be asset managers and mutual funds, etc., were experiencing redemption pressures, and then it was becoming a self-fulfilling loop. They were experiencing redemption pressure, so they would sell a bond. They would sell a bond at a significantly high yield. People would relate that secondary market yield to the health of the company, which is absolutely, because it's the problem actually is of the mutual fund, not of the company. But I'm sure if you talk to market participants, oh, this bank CD was sold at this level, but it's it's the mutual fund problem, not the bank's problem. But that journey these days is not very long. It from a mutual fund problem, it does become the issuer's problem or the underlying security. So I think what this TLTRO clearly does is address your question, that it ensures that any mutual fund who wants to sell has found a new bunch of buyers who have a limited window in which they've got term funding at relatively attractive rates, and therefore they address the distressed sales of mutual funds plus 50% of the regulated primary market. My sense is I think they need to and they should do significantly more of it, so that just keep announcing that they'll do it, so that there is no sense of, oh my God, the window has shut on me. So I would say for TLTRO 1, yes, we have finished the 4 repos of 1 lakh crore. I think there is no harm in announcing another 4 of 1 lakh crore, so that even if the take-up starts tapering off quite a bit, but you should know if you are a AA plus or that, because this is largely, let's face it, going to the big names or the highly rated names, but it's very important that they be lubricated. And then I think to that extent, large companies is where less of the focus from a liquidity availability perspective. Less of my concern is there. On the international side, your question, yes, clearly a lot of companies borrowed last year, and even up to, I would say, Jan and Feb of this year also, when the markets were very, very open, both bond markets. Largely, it was international bond market, some loans as well. My own sense is that a significant portion of those being hedged. Okay. And therefore, unlike earlier periods of rupee weakness, where just when you don't want the people to buy dollars, people were coming in to buy dollars because they certainly experience their own committees and boards getting nervous about the extent of the open unhedged positions. My own guess, and at least we as a bank haven't seen it, so I can only talk about what I see, but I also talk to people. So I'm not seeing anywhere the sense of panic on that side. And I think the third element is some companies who have borrowed offshore and are, obviously can't go offshore. And that's where the domestic liquidity, why every central bank is flooding the system with liquidity is to avoid such situations, because a one-off negative piece of news these days can become a bigger problem than it would be under normal circumstances. So I think, I don't think it's the unhedged foreign currency exposures, to my mind, are a much lesser problem than what they historically have been. Simply because, for example, we as a bank have to provide extra capital if I have a borrower who has a foreign currency exposure and it's unhedged. So, I have an incentive to keep telling him to hedge with me or with whoever else. Secondly, I think just on the currency, I know your question is not on the currency, but, so one is the financial market.
I was going to come to that, so please go ahead.
So, but, whichever way you see it, there is $10 billion, let's say, of withdrawal in the month of $11 billion, I think, in the month of March or so. But from April onwards, $5-6 billion of that gets funded effectively through the lower oil cost itself. I know we are right now, I think, as per newspaper reports, using these very low prices to fill up our reserves, emergency reserves or strategic petroleum reserves, as they're called. So therefore, the oil bill might not come off immediately, but eventually then, so if you have a situation where your largest import commodity is down, I don't know, more than 50% now actually. Today it's down quite significantly further. Some of that gets funded through that. So I think on the currency side, you would have to say that at some stage when the financial market volatility stabilizes, which I guess the final solution to that will be when somebody says there is a tested and approved vaccine which works. Okay, when that happens, obviously that will be the ultimate day. But in the case of India, I think clearly, how our lockdown lifts, how the numbers on the virus side progress over the next 3-4 weeks or so. I think that also will tell people, because every country has followed their own path to containing this. Ours has been the most extreme. So the operating assumption one has to have is, since we have paid the heaviest economic price in the short run, our path to recovery should also therefore be the sharpest. That has to be the operating assumption, that because you paid the heaviest economic price in the very short run, and we've effectively had the most effective social distancing policy of all the world, and therefore you would expect that our recovery should also be faster, and therefore that should weave back into the financial markets.
Right, Mr. Dave, I'll make this my last question then. You're sort of keeping an eye out on everything that's going on. We've already spoken about the potential fiscal response and the uncertainty there. But are there any specific red flags you're seeing right now in the financial markets or in the corporate sector that you think need to be addressed with some immediacy, sir?
No, I think everyone sort of is talking about the fact that, the banks have more than enough liquidity. Like I said, the large corporates are able to access. The bottom of the pyramid is able to access. I would say other financial intermediaries, which we call NBFCs, I think somewhere we need to find a solution to that, because they also lend to a lot of these mid-market, as MSME, etc. So you don't just solve for the NBFC, you also solve for their end borrowers in that, even though they might or might not lend in the current environment. So that I think we need to figure out, and let's see how this TLTRO2, which has been announced specifically. I think there's lots of discussions happening on whether some of the conditions there can be tweaked a little bit to make it more easier to access and implement. That would be one. And the second is very clearly companies, I think, that employ between 3 to, let's say, 50 employees. I think somewhere, because it's not just the business which is at risk there. There are all these employees who are also at risk there. I think how to get, like I said, this is a cash flow problem. You've solved the cash flow of the government by saying, okay, RBI will give you. You've solved the cash flow of the larger companies by saying, okay, I'll give you TLTRO related extending in bottom of the pyramid through the Jan Dhan and the DBT. I think in this pack, the NBFC and the companies that these guys lend to, and the companies that hire between 3 to 50 people or 3 to 1, you can take your pick, whether it's rate enhancement, whether it's anything else. Somewhere I think that segment has to get access to funding, so that when the lockout lifts and the economic activity starts resuming over the coming few weeks, they're not starting from an absolute standing point. There is something with which they can move forward. I would think the cash flow problem of these two segments, I think we need to focus on. I think if we can fix that, then I think we'll come out of it a little better than what many people think.
And bond markets?
No, I think it's the central bank is saying I'll do what it takes. I mean, I think there's a maxim in the market: you don't go against the central bank, you don't bet against the central bank. I mean, I think it's one of the most attractive asset classes right now. There is no. I think the fear of the fisc and the blowout, etc., are real. But I think all the steps they have taken, increasing the size of the T-bill auctions, increasing the WMA limits for states. You can clearly see which way they're headed. They're keeping the WMA creates liquidity. That liquidity feeds T-bill appetite. Let's see if these two things are linked with a reduction in the dated bond supply, etc. You're able to refinance yourself at anywhere between 2% to 2.5%. I name me one asset class in India where you can earn 300 basis points, and I'm taking therefore it yields at 5.5, not really at the prevalent level. And it's risk-free. You don't put aside any capital. I think it's one of the best asset classes in the world right now. I just hope the fiscal package is such that it doesn't create massive doubts at the long end, and that's why very important to be having a comprehensive package, that extra borrowing and the highlighted sources, so that everybody gets confident that we're not permanently into this borrowing every year.
All right, Mr. Dave, I'll leave it at that. Thank you so much. Appreciate you taking the time to speak to us here on a host of issues related to this crisis. Thanks for watching BloombergQuint.
According to a recent report, women today contribute nearly 74% of real estate buying decisions. This includes